Welcome to the Modern CPA Success Show, where we're 100% focused on helping accounting firms achieve success. If you're an accounting firm owner who wants to learn how to grow your firm by providing virtual CFO services, then this podcast is for you.
Hello, everybody. Welcome to today's podcast. I'm really excited for today's topic because we are going to do some speed dating, which we will get into in a little bit here with Randy. But real quick, want to welcome Adam to the show again.
Hey, everybody.
And then, our guest today is Randy Crabtree, who's with Tri-Merit. He's a partner over there. And before the show, he was kind of talking about how he likes to introduce different types of credits and kind of thinks of it as speed dating for business owners and accountants to know what the credits are and really jump into it. So, Randy, you want to kind of explain that topic a little better than I did?
Yeah, sure. I mean, we can go into anything you want when we're talking about this, but I just, maybe geeky, I don't know, but I just love talking about credits and incentives, and there's so many opportunities out there for taxpayers or CPAs to help their taxpayers save some money. So I just developed this webinar, and I do webinars all the time. I just developed this webinar back in November or something. I've been doing the version of it lately, which, I really am calling, permanent tax credits and incentives, what your clients need to know post-COVID relief. But when I'm talking, what I really say is, hey, what we're going to do is we're going to do a speed dating with credits and incentives. I'm going to talk about these 6 different things. You're not going to become an expert in the hour that we're doing this or the 30 minutes we're doing this, but I want to give you a high-level idea of what's going on with these, and then speed dating, and then after that, you as the, let's say, tax preparer are going to play matchmaker, and you're going to take whatever credit or incentive you found interesting, you found that ABC client or XYZ client could use, and you're going to go introduce it to them and hopefully save them money and become a hero in this whole process. So that's it.
Great. So let's... Cool. Yeah, no, I'm excited to get started. So let's hear the overview.
All right. So I'm going to jump into it. So the problem is, Jamie, when I start going, you're going to have to interrupt me to stop me. So interrupt anytime if I'm going off track. But this is I just love talking about this stuff. And the reason is when we're talking credits and incentives, again, I told you I get excited on this. When we're talking credits and incentives, clients, taxpayers, we've been programmed for the last 2 years, through COVID relief that, hey, there's money out here available for you. There's PPP, there's employee retention credit, there is, child tax credits, restaurant revitalization grant, FMLA, FFCRA, all these different things were out there, and people realized it, and taxpayers realized that there's potential benefits for them. But that doesn't end with COVID relief. There are things that have always been part of the tax code that are out there that can do the same thing for you. And there are things that are still part of COVID relief that are going to exist for the next few years. So what I do is go into that. And if you want, I can just list all 6 and we can decide if we want to talk about one.
Yeah, absolutely. Yeah.
All right.
If you want to fire off.
Let's do it. So there's really, like I said, 6 things that I spend time talking about. And those are, well, funny. They coincide with the 6 offerings that we do as a business. But research and development tax credits, and it sounds like you have some audience that may be very interested in those. So research and development
Absolutely.
tax credits been part of the tax code for a while. There's some real estate types incentives, cost segregation, which is accelerating depreciation on depreciable property, 179D, which is accelerated depreciation for commercial property that's energy efficient, and there's 2 ends of that one. One is anybody that owns a commercial property, but 2, if you're a designer of a government building, you can potentially get this phantom deduction, which ends up being free money to that taxpayer as well. 45L, which is a credit for developers of low-rise residential properties. Actually, significant benefit there. Those last 2, 178D and 45L, big proposals to actually increase the benefit on those. Hopefully will go through in the next few months or so. They were supposed to go through in the Build Back Better bill, but that's just been sitting on hold for a while. We'll see what happens. And then the 2 others that I talk about are employee related. Work opportunity tax credit. It's a new hire credit. Anytime you're hiring somebody that meets a certain geographic or demographic requirement, you can get a credit for that. And then the big one, which everybody's heard about, everybody's getting marketed to on is the employee retention credit, the most marketed tax incentive in the history of the world. And in reality, I'll get on my soapbox for a second, probably the most misinformation out there than any other credit I've ever. R&D was misinformation for a long time. Employee retention credit, there's just a lot of misinformation out there on that. So those are the 6 areas I can expand on or talk about, or ignore all 6, whatever you want.
I'm curious because I know Adam's done a lot of speed dating in his life, so I'm curious which one he thought was the cutest. So I'll let him,
well,
dive in.
the one, I mean, obviously, like the ERC is probably the most relevant right now, and I agree. There's probably a lot of misinformation there. I think the one that's nearest and dearest to my heart is the R&D credit, because, like you said, they a couple years back they expanded that to a lot of internal use stuff, and I think that's whenever it became a little bit more advantageous for a lot of companies out there that are just doing regular stuff that they don't really think of, that really qualifies. So I think it opened a big door for those folks. So those are probably the 2 big heavy hitters. Cost segregation, it's always been. Let's pick on cost segregation for a minute. Let's pick on and we can kind of circle back to the more popular ones there. But
Yep.
like on cost seg, what's always kind of confused me a little bit is, I know it stinks to own a building and have to take that stuff over 39 years. Right. Understood. And then to be able to accelerate that depreciation in real time obviously has huge advantages on the front end, but ultimately at the end of the day, and I get it, time value of money, right? But depending upon the cost of the study and how that works, like where do you see those breakpoints where the cost benefit really makes sense, since it's basically just pushing up the same benefit. It's not like in addition to.
Right. And what Adam's saying is, I got a commercial building, I'm going to write that off over 39 years. With cost seg, is what we do is we accelerate a portion of that building to write it off today rather than 1/39th of it. So over 39 years, the benefit's the same. But Adam said, the today, money in my pocket today is worth a lot more than money in my pocket 39 years. But there is a point in time where it does make sense and doesn't make sense. One is, what's the size of the property that we're talking about? Did we invest $500,000 in this, whether it was a purchase or a construction or remodel? To try to get a benefit out of that dollar amount today is not that significant. Probably $1 million of a property and up is where it makes sense. And then one thing we do is, when we're doing this, we do a free analysis on it. And I'm not selling. This is just in general, telling you how this works. We do a free analysis because you don't know if the benefit's there. And so let's do a benefit analysis, but on top of that, let's do an ROI. What's the return on investment for this? And if we get something where our fees are 10 times the return. I mean, our fees are 1/10 of the return, not 10 times.
I was going to say
that.
Wow.
That would be
Jamie,
a bad
mark that
scenario.
down. We're going to start doing cost seg studies.
Yeah, I got to start billing like. No, I am not going to start billing like that. That's pretty low return on investment. We really like to see 5 times our fee is the current net present value of the benefit. But anything above 10, at least it makes sense to look at. 10 times our fees as the return on investment, but that's always the client's or the tax preparer's decision.
Gotcha.
Yeah, we don't
Yep.
we don't force anybody to do anything. So yeah, it's $1 million and up, and then ROI we want pretty significant.
Gotcha. Yeah. And what are you
Very good
typically
say.
finding that to be, that accelerant? What percentage of $1 million ish, if you just had to kind of average it out, that you're able to accelerate?
It depends on the property, but let's say a high-end manufacturing facility, you could get up to 60+%. Where if you're let's say just a storefront, maybe it's 25-30%. So it just depends on the property, and then it also depends. We went through some nice fixes to qualified improvement property. It's just a way we can accelerate even more of a building that went through a nice fix about a year ago, and so that could increase. Like we just did one. It was a $2.5 million medical practice. They just did a remodel of their entire medical office space, and in the first year we got about $2.3 million of that. We were able to write off because of this rule on qualified improvement property, which is improvements to interior portion of a commercial building. So obviously, the percentages could be all over the board, but on average, 30, 40% maybe.
Yeah.
So if you have commercial property, I mean, I think the key here is if you want to talk to someone, make sure you're looking at the value obviously, and then what the return on investment is. I think those are the two things to look for when you're talking to a professional. And again, you don't want to get carried into something where you're paying a ton of fees and only getting one times that or two times that. It's just not worth it. So we want to make sure we're getting some return on it.
Yep.
So
and then Jamie, the holding period's important too, because if you're gonna sell this in 2 years, well, it probably makes no sense to do cost seg. If you're gonna hold it for the next 10 years plus, well, yeah, let's look at it. So that's a big deal as well.
Yeah, it makes sense. And I mean, just staying kind of on the real estate thing, that's where the energy efficient initiatives really come in too, right?
Yep. Yeah. So just to wrap up those, the 179D is pretty cool, and everybody gets really excited about this free deduction for architects, engineers, general contractors, mechanical contractors, if they can be shown that they're designing a government property. And what happens is if they're doing that and it meets the energy efficiency requirements, the government entity could allocate this deduction to the designer. So if you have an architect that just designed a 100,000 square foot university building, government owned, they can get this deduction allocated, assuming it qualifies, and in that scenario could be up to $180,000 deduction. And now this architect is just going to have a $180,000 deduction on their tax return for money they didn't spend. So if they're in a 30% tax bracket, they're just, if my math's right, save $54,000 in taxes for money they didn't spend. So that's pretty cool. But that's the one everybody gets excited about. But if you own if you own a commercial building, you can also get this deduction. For you, it's just accelerated depreciation, kind of like we talked about with cost seg, where we're going to accelerate it from 39 years in this point to a portion of it just written off in 1 year. And so that's the 179D. That's probably about as much as you need to know on that, unless you guys want to go deeper.
That's more than it's above my pay grade already. So no, you're probably good. So if we didn't say that before, it's like, a lot of times I think the CPA firm community in general, I think doctors are better at this, but I'll call out lawyers too. Sometimes we have a tendency to just be generalists. And it's true, yes, we know a little bit about everything, but whenever it comes to some of this stuff, you really want somebody that specializes in it and knows these kind of things, because there's all kinds of, just like you said, whether it's running the cost benefit analysis or just understanding what's available and what's not. If you're going to go down this road just to maximize what you're doing, you really want to find a specialist. You wouldn't go to the foot doctor to talk about your heart. That's the way some of this stuff is too. And tax credits, these more advanced tax credits, again, it's not that your local preparer can't facilitate them, but whenever it comes to the analysis and preparation and making it audit proof and everything, it really, we always look for and work with a firm that specializes in these kind of things. So that's what
we've all made that mistake before.
Yep.
Of someone asks you what you do for a living and you say I'm a CPA, and you never know where that path is going to go down. So we've all made that mistake once, and we're like, nope, you never know what they're going to ask me when I tell them I'm a CPA.
Well, I know what they're going to ask you.
Let's avoid that.
It's like whenever you buy a truck and your buddies, as soon as you buy a truck, now you got to move everybody. When you're a CPA, they're like, oh, you want to be the treasurer of the board.
Exactly.
So you get volunteered to do the books of everyone. It's like
every time
if you knew half the CPAs, you know better than that.
Yep. Every time I'm asked to be part of a board, I'm like, all right, but I'm not going to be treasurer, and then that's what they end up wanting me to be. So that's it. You're right. So real quick, I want to touch on what you said, Em, because I grew up as a generalist in accounting, and enjoyed it, knew, like you said, these things exist, but was never a specialist in anything. 15 years ago, I left, we merged our firm and I decided to do something else, and we started, this current business, which is called TriMerit, and we do specialty work. not that generalist isn't fun. I've never had so much fun in my life being a specialist and being able to dig into small section of the tax code, which to some people will probably sound pretty geeky, but to dig into small sections.
It's okay.
Yeah, exactly. You are right. I agree with that. But it's been fun. It has been fun because what we do now is everything we do puts money back into businesses. So you can't beat that.
No, absolutely. Exactly.
Are you interested in offering virtual CFO services at your firm or scaling your existing service offerings? The Virtual CFO Playbook, How to Land $60,000 a Year Clients and Provide a Killer Client Experience, is an online series of modules that will equip you with essential tools for creating and delivering scalable VCFO services. These approaches have helped Summit CPA grow from $500,000 to upwards of $5 million in revenue over the past decade. If you're ready to grow your firm, visit summitcpa.net/VCFO Playbook to enroll now.
So, I mean, kind of shifting gears, we talked about the hard assets with the building and the cost seg and the energy pieces, but the rest of them are really revolved around humans and people, whether we're talking about like the ERC credit, which we can kind of dive into. But I think, and even the R&D credit, obviously that's a lot of that for at least with the clients that we work with, that's a lot of people hours going into that. There's not always a ton of hard costs going into that. But before we jump into that, the one that I don't think a whole lot of people think about outside of maybe the restaurant industry, I think this is kind of a common thing that they think about often, is the work opportunity tax credit. You mind explaining a little bit about what that is and how that works?
Yeah, well, just real high level. It's you want to think of it as a new hire credit. Am I hiring new individuals? If so, let's see if they meet requirements to get a credit. And people are used to employee credits with the employee retention credit right now. Kind of think of it as somewhat similar. I'm going to get credit for not just retaining somebody, but for hiring somebody now. And to get this credit, you have to hire somebody that meets a certain requirement set out, either a demographic requirement or a geographic requirement. Somebody that lives in a certain area. And it's usually, like you say, restaurants. It's usually a higher turnover, probably lower paid position that becomes eligible for the credit, but you hire somebody on food stamps. They're potentially qualified. Somebody that's been long-term unemployed, which is 6 months, which you probably have a lot of that still out there right now, just from what we're going through. So someone who was out of work for 6 months, you hire them, they can qualify for this. And there's a completely separate category for veterans groups that you hire a veteran, you can get credits for. And the credit can be anywhere from $2,400 to $9,600 per employee. And so you want, it's a standpoint from the credit, you want to have. You don't want turnover, but you want to at least have a decent amount of new hires a year, because if we analyze 50 employees, maybe 5 qualify, and if we got these 5, maybe we got somewhere from between 10 and $40,000 credit, and then it starts to be real money.
Yeah.
I think the key on this one, and correct me if I'm wrong, but I think this is the key on a lot of these credits is making sure that you're, keeping good documentation, right? So like if you come in and how many new hires have you had? What their qualifications? What are their cases? What are their situations?
Yep.
So that way you can come to your tax preparer and be like, hey, this is who we hired this year. Do you think there's any credits we might be eligible for?
And you're right on. Other than this is not a at the end of the year thing. Unfortunately, this is very time restrictive. And you have to submit the new hires to the state. The state administers it for the federal government. Okay. You have to submit the information within 28 days of somebody being hired.
Oh, okay.
And
there you go.
So that's the biggest thing. And then, unfortunately, you don't know for a year, maybe 2 years, some places longer, if the state says yes, they qualify. But you start the process. You start getting these submitted, and then and there's a form where you can ask these questions, which it's completely legal to ask, and then submit to the state. But you're getting into some personal information when you're asking these questions. So yes, time restrictive. Yep.
Yeah, I mean, I know the payroll companies will a lot of times get involved with these, especially with restaurants and things of that nature. But yeah, that's what I was always kind of, because it's also people with disabilities, right? So it's always been one of those things where, I don't know, everything that you read about and know about HR, it seems like everything that you would need to do to complete this this piece. And I know some people will actually come and bring it up and say, hey, by the way, I qualify. And they might already know that they pre-qualify for these opportunities whenever they come to you. But aside from that, it just seems like, I don't know, that not typically what you would put on your questionnaire in terms of are you disabled, were you on food stamps, so those are obviously that makes a little bit of a barrier for some of this stuff. But like you said, there's also a threshold of wage, right? To where these things make sense, because it's not for somebody that you're hiring that makes a couple $100,000 or what's the cutoff there?
So it's just based on somebody has to work for 120 hours before they're qualified, and once they hit the 120-hour threshold, then you get a portion of a portion of their salary for. And honestly, we have somebody that heads up that team, and I'm going to get the math wrong on this, but for up to 600 hours, and now we've got a full credit for them. So really, higher paid individual you can get, you're just not going to have a lot of new hires at $200,000 a year, and that's why typically it's the fast food restaurants you see this, just because there's more turnover and there's more potential eligibility. But it could be I could hire a veteran that's spent the last 5 years doing these high tech work for the government, and maybe they have some qualification based on being a veteran that they still qualify. So we could look at, but that's not the common user of it. You are correct.
Yeah. Okay, so that's on the one side, and then let's. Which one do we want to tackle here first? Do we want to go for ERC or R&D?
Let's end with R&D. I'm saying. What do you think?
Okay, so make everybody wait and think about that one. Okay, so you're saying common misconceptions, and believe me, I agree with you, because I remember just like researching that one, and just at first it was honestly for me a good get out of jail free card was that we took the PPP loan. You know what I mean? Right. I was like, whenever you did the math, it was like the PPP loan was always way more advantageous than doing the ERC credits. And then the government originally came out and said, okay, it's pick one, but you can't do both. And you're like, I'm like, oh, cool. Well, ran the analysis a bunch of times. I don't have to deal with payroll. I don't have to deal with all that mess. And then they came out and said, you can do both. And so then I was like, no, now we have to go do all these calculations, figure this stuff out. Again, let's go find somebody that specializes in this. I know it's not, for those folks that do it all day long, it's not that difficult. But for the rest of us going through and thinking about amending payroll tax forms and all those kind of things just is really on the bottom list of anything that I could possibly imagine I'd want to do. So with that awesome intro into ERC, why don't you explain to everybody how awesome it is and why they should be thinking about it, or some of the common misconceptions, I guess.
Yeah, sure. And so I had the opposite reaction you did when that changed. I just became intrigued with it, and I had no plans to even originally make this a service offering for us. It was I think January 7th of 21. I started reading the changes that came out in the Consolidated Appropriation Act, which has really updated this, and I see Jamie's already getting bored hearing about ERC.
I need to open a window or something. Here.
But it was just amazing that now the PPP you could do both, like you said, Adam. And so that's great. There was a misconception at the beginning about, hey, well, if I took the PPP, I'm not doing ERC. That changed in the CAA. But then it was, I used all this period for PPP forgiveness, so that period's not available for ERC. That is wrong. It depends on how you did forgiveness, but that's not even the misconceptions I'm all that important about or concerned about, because I can fix all that stuff. I can work around that stuff. The misconceptions are there are people. How do I say this politically correct? there's a lot of ERCs being taken that I don't believe exist, and that's where I can get on my soapbox, because not everybody in the country qualifies for the employee retention credit. It doesn't happen. It is not out there. There's plenty of companies that qualify that haven't taken advantage of it, and there's two ways to do that. There's a safe harbor. I had a significant drop in revenue in any quarter in 2020 or 21, and significance defined different in each quarter, but I had a significant drop. Okay, I qualify. Boom, safe harbor. No questions asked. I don't even have to prove that the drop was due to COVID. I just have to show that I had a drop in revenue compared to 19. Everything's compared to 19. The other issue is then, if I don't have this significant drop, can I still qualify? Some people think, well, no, I didn't have a drop. Well, you can if you can show that a government mandate affected your ability to conduct business in some manner. And I can go deep into that, which we're not going to do today. But that's where people are
Jamie
missing
really wants to hear more about that. he's I can tell he really wants to hear more about that. Maybe you guys can do that offline.
We'll do that offline, which is fine.
Okay.
And so just a quick, that's where people are missing, but that's also where people are qualifying companies that don't qualify. Because, you had to wear masks, you qualify. No, that's not the case. So you have to really dig deep and show that there's an effect before you qualify. But the numbers could be huge. The numbers could be up
some
to
of our clients.
You could get as much as $26,000 per employee if you qualify the entire period. So it's just a refund check. So it's a big deal. It's worth looking at.
Oh yeah, no, we've had some clients really do well with the ERC credits. And so as a baseline, interruptions aside, as a baseline, the way I always, and correct me if I'm wrong, the way I always kind of looked at it is like the first qualifier for me was, did the client qualify for the second round of PPP? Mm-hmm. Like if they qualified for the second round of PPP, then you knew they had a significant drop in revenue, because that was kind of the bar that was set for the second round of PPP. So that was kind of like always my first thing. If they didn't qualify for the second round of PPP, that's whenever I'd usually go down the road of like, that was my decision tree anyway. Initially, whenever I was consulting clients before I'd bring in somebody to actually put the numbers together, then I would always be like, okay, if you didn't, did you have an interruption? Were you mandated to close? Was there? And then the one that I was probably always a little sticky on was, or not as up to speed on, was the supply chain issues that maybe you could argue that the supply chain, maybe not directly a government update, mandate to close down, but some supply chain issues that you were kind of impacted. I know that one can kind of be a little bit of a gray area. So we would have those conversations. And as soon as we had those conversations, and we tried to be as conservative as possible on those, if they went anywhere, then we would kick it over to a professional like you to be able to, articulate it and calculate it and see if it made sense. And then same way with the round 2 PPP. Does that like logic tree sound reasonable?
It's reasonable. The drop in 2020 was 50% for safe harbor. So 25% drop qualified you for round 2 of PPP. So there was an effect. You may not met safe harbor rules, but something happened. Why did I drop? And that's where you start to dig deeper. Why did my revenue drop 25%? What caused that? Was it just a lack of demand, which IRS argues does not qualify you, which I'm not completely agree with. It just depends on situations. Or was it, that you were shut down or your suppliers were shut down? The supply chain is just, that's a tough one. Because a lot of supply chain issue was just a demand issue. Demand went way up in our country, and because of that, supplies were harder to get. People argue, okay, supply chain, I couldn't get things, so I qualify. That you got to dig deeper than that. It has to be a COVID effect to do that. So,
gotcha.
Yep. Right.
No, that makes a lot of sense. So the whenever we're kind of talking through that with the ERC though. Just before we leave that topic, like you said, and there is a lot of work that you kind of have to do there, calculate if there was that drop, and then, you're going to get a certain amount per employee that, of course, you can't double dip in your PPP money or PPP round 2 money. So you have that little offset. They extended the time frame, so a lot of folks did actually end up qualifying for it. And then typically the way that works, whenever you find a firm that'll work with you on that stuff, they'll do all the amendments for you, right, as part of their fee.
Yep. Yep.
And then what's a typical fee that a client should expect to pay for that type of service?
Yeah, a good estimate is maybe on the high end, although I've seen it higher than this, but on the high end, I think it should be 15% of your credit for a smaller company, and maybe going down to 10% or less on a larger company of the credit. And so, you just saved $100,000. Your fee should probably be around $15,000 for that tax savings.
Okay, because that one they did allow to be contingency based, right?
Yeah, that's what we feel. Most people are charging that way. There are still probably people that may think, you can't, but it is amended returns, and there is a carve out for amended returns, so we should be all right.
All right. Here's the big lead up. Jamie, take us home with all your R&D questions.
All right, let's dive into the R&D. So I know, obviously, a lot of our clients are in the digital space and in the agency world, and there's a lot of hours tracking, and that goes into the R&D credit. And I've had a lot of clients come in and say, "Hey, tell me more about this." And I say, "Okay, let's bring a tax guy in to give you the specifics and kind of the qualifications. And then once we get through those qualifications, what we need to keep track of." So let's dive into that a little bit.
Yeah, this is an extremely interesting area. Again, I get excited about this stuff because major things just changed in January of 2022 on this, and so we might want to touch on that a little bit. But just should I give you the definition and how these agencies, what we see? Okay, real quick.
Yep.
R&D tax credit, different than what it probably brings up into your mind. It's not weight lab coats. It's not developing a time machine. It is, are we developing something new or improved? And the code says new or improved product, process, technique, formula, invention, or software. Software is specifically called out as a qualified activity in the code. And then what we need to do is just, are you in this case, let's say it's all software based, are we programming something? If we are, that's an activity that qualifies. Are we testing a new program? Are we developing new modules? Are we developing new components within these modules, new capabilities? That's all qualified activity for research and development tax credit. And that is right there. That's the quickest definition of R&D I've ever given. Do you want me to expand on that at all?
No, I'm proud of you. That was great.
Yeah, I think that's the biggest misconception is everybody thinks you're like building the time machine, and it is lab coats. So it really is about just improving even process internally. Yep. It doesn't have to be a physical thing, which I think is really unique, and it doesn't have to be something that you plan on selling because, again, improving a process, it can be something internal, which they came out a few years ago. We talked about a little bit earlier, that I think was a big eye-opener and a big change for a lot of folks in the space that we work in. But then, kind of moving that forward, what were the changes then in 2022 that people need to know about?
Yeah, this is big because if you've taken the credit before, one way of documenting and one way of submitting it. And the way that the credit has been submitted in the past has always been File Form 6765, which is the tax code that you put the R&D tax credit on. That is still acceptable going forward on currently filed returns. But if you haven't taken the credit and you want to go back and see if you have past credits that you haven't captured, and a lot of times in software development, people aren't thinking it's R&D, and so we go into an agency or wherever it is, somebody, a CPA firm that develops software, and they weren't even thinking about it as an R&D, and all of a sudden now it's an R&D project that they did 3 years ago. Well, to capture that, we have to amend that tax return. The credit has to be taken in the year the activity is incurred. And so to amend going forward, this is the big change. IRS surprised us October 15th and said, hey, we got new rules coming out for amending, and they didn't even specifically say amending. Everybody thought they were talking about amended returns, but we weren't sure. If you are filing R&D tax credit, these rules are going to change. They told us it was going to go into effect January 10th of 2022. January 3rd of 2022, they clarified everything for us. And the bottom line is, if we're going to file a tax return, an amended tax return, to claim an R&D tax credit, we have to now show every what they call business component, every business component the credit was based on. So this module we just programmed, that's a business component. Now, who was working on this module? That's what they want to know. Who were the individuals in the company that were programming, testing? What were the research activities each individual was doing on each business component? And what were they trying to discover, overcome? What were the uncertainties that each individual is working on? Which is documentation we've always done. We never had to submit that. Now, going forward, when you do this, you have to submit this additional information. We have a 1 year grace, not really grace period, but somewhat a grace period where if we do it wrong, they're going to give us 45 days to correct it. And then after this 1 year, who knows what happens. I wouldn't be surprised if this works well for the IRS, that they will extend this to all R&D tax credit filings. That's just a guess on my part, but I think we're kind of in a test phase to see if we need to do this going forward. Don't let people get scared about that. This is how you're supposed to document the credit anyways. It's just a matter of you never had to submit it before. And so that was a big change.
That's only with the amendments. That's not with current
Yes.
year stuff. Okay.
Correct.
Yeah, which
Correct.
is strange because you think that would just, I guess it's just another hurdle because we all know the IRS is pretty strapped for
Very.
talent these days. So
Well, to say they're hiring all these agents,
Yeah.
that's what they're going to be doing.
I have a hard time
Looking through
believing
hours.
they're going to be reading through a bunch of R&D literature. But who knows? Like they just, I guess, make the hurdle a little bit higher for people to go back and stretch for it.
Right.
You know, not the not so compliant folks, but as you mentioned, that's just kind of par for the course anyway. You should already have that study done. And again, that's why rather than going to just the prepared on the street, whenever you go to a specialist, they have a lot of these forms and a lot of this, you know, how this should be laid out. It's kind of templated so they can, you know, fill in the blanks and give you a real professional looking document.
Yep.
That you don't have any problems submitting to the IRS.
Can I expand on one more major change that kicked in this year with R&D expenses? I don't know if you guys are familiar with this or not, but the Tax Cut and Jobs Act defined how we treat R&D expenses on a tax standpoint. You know, we've always traditionally, almost every client has deducted R&D expenses as they've incurred them. It's just they don't even know they made this election. They had some R&D expenses. It was hidden in salaries and wages. They deducted it. They made an election to expense it. Starting January 1st of 2022, you can't do that any longer. You now have to capitalize all your R&D expenses and amortize them. If it's a U.S. expense, amortize it over 5 years. If it's a non-U.S. R&D expense, you have to amortize that over 15 years. So all of a sudden, you know, a small business's tax bill is potentially going to skyrocket. You know, a $3 million software development company could very well have $2 million of R&D expenses, and now they can't deduct that $2 million in 1 year. They're going to actually the first year they're actually only going to get 10%. So they're going to deduct $200,000 the first year rather than the $2 million they normally would have, increasing their taxable income by $1.8 million. That's a big change.
And you're saying
to
they're
someone's
supposed
tax
to
bill.
do that regardless if they think about doing an R&D. So it's almost forcing everybody to kind of think about an R&D tax credit because you're saying that, you know,
Yeah.
that's not if you file the R&D tax credit. You're saying
this
in
has
general,
nothing to do
you
with
have
the
do
credit.
that. Right. So if
in
the IRS
general.
comes knocking on your door and just says, hey, we determined that you were doing a lot of R&D activities, they could potentially capitalize some of your expenses, which means you're deferring them, and then you owe a bunch of money in tax because you didn't. And you can't just click a button and opt out of that, huh?
No. Now, so we talked, I think we may have mentioned the Build Back Better bill earlier, or at least pre-gaming we did, I'm not sure. In there, they were going to kick this down the road till 2026 and delay this even further. You know, when it was originally defined in the Tax Cut and Jobs Act, it was delayed for 4 years. This was going to delay it again. Obviously, that hasn't passed. We're very hopeful this will get delayed, but honestly, you know, we're coming up to, you know, first quarter estimates soon. I think we need to, you know, take this into account when we're doing first quarter estimates for taxpayers because this is a big deal. This can increase taxes quite a bit.
For sure. Cool. Well, we are right up against time, so I think we've all learned something about Adam's dating style. That he's interested in all 6.
I'm a talker.
He's not
Yep,
gonna.
that's right.
He's not gonna stop at 1 or 2. He's gonna go into all 6. But I think that was very helpful for our listeners to at least speed date the 6 topics here. And I think hopefully people understand. I think the biggest things is make sure you go to a specialist. You want to make sure you go to someone that understands this, and not just the tax preparer down the street. But any other final thoughts from you, Adam?
No, that's probably the most important. That seek somebody out like Randy who does this for that's his day job and that's all he does. He'll be able to go a mile deep on these particular instances, and that's who you want in your corner whenever you're going down this road.
How about you, Randy? What's your final thought for our listeners today?
Well, I agree with Adam. They don't have to reach
Hire
out
Randy.
to me, but that's okay. I agree with Adam on that. But no, I just it's very important to look at all this stuff, and there are tax saving opportunities. So yeah, seek somebody out, but be careful, beware. Don't make sure that you actually qualify for these things before you're taking advantage of them, because that's what I've seen not only in ERC, I've seen it other places as well, and that. I just want to thank you guys. I had a great time. This was a different topic than we originally thought about, and hopefully it was good for you. But if we ever want to talk about building a niche practice, I'm extremely passionate about that as well.
I'm sure it sounds like there's lots of things you're passionate about. So definitely appreciate you coming on the show, and that was a good topic here. And thanks for joining us.
Well, thank you, guys. Great.
Enjoy this podcast? Visit our website at summitcpa.net to get more tips and strategies for achieving modern CPA firm success. We're here to be a resource in this ever-changing industry.